Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Artificial intelligence has sent the market into a frenzy, and there are a handful of stocks that have just absolutely gone crazy over the last few months. Three that have really risen sharply that I think investors need to start pulling back from are NVIDIA, Adobe, and Meta platforms. And I want to get into exactly why we should be cautious about those companies in this video. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with a couple of charts to put the price that we're paying for these stocks into context. This is the price to sales ratio for NVIDIA, Adobe, and Meta platforms. Now, typically a price to sales ratio for an industrial company would maybe be 1 or 2. Tech companies can trade in the mid single digits up to 10 if they're getting really expensive, because those are generally higher margin businesses or can be long term. But once you start getting into 40, 50 price to sales multiples, now you're starting to talk about companies that are incredibly highly valued, have a lot of growth priced in. That's where we are with NVIDIA. Now, the company had a phenomenal quarter in the first quarter and their guidance was unbelievable. But for the company to live up to a 40 price to earnings multiple, they're going to have to grow revenue 50% plus for many, many years into the future. Adobe and Meta platforms are obviously slightly lower multiples, but these are also very mature businesses. Adobe long ago made its transition to subscription products. I think the hope for artificial intelligence is that it's going to be able to broaden the base and attract more people to use some of its tools like Photoshop using artificial intelligence, maybe make some of those products a little easier. But again, does it deserve for the stock to be up as much as it is over the past year? Same thing for Meta platforms. This is obviously a very well-positioned company, but if we start using artificial intelligence to serve up ads in Meta platforms properties, those ads are actually going to get more expensive. And you may not realize this, but Meta's margins have actually been going down as it's already been using things like machine learning and artificial intelligence in advertising. If we look at the price to earnings multiple, now things get even wilder. NVIDIA, 225 times earnings is what it's trading for currently. Now, this is trailing earnings, so that may look a little bit better on a look forward basis, but still a very, very expensive stock. Adobe, again, very mature company, trading for 46 times earnings. That's just a crazy high price. And Meta platforms, 35 times earnings. That's actually one that I think could be attractive if they cut $15 to $20 billion a year in spending on the VR and AR business. But that doesn't seem like it's going to be happening. So as long as Mark Zuckerberg is intent on burning that money trying to build out this Meta business, this VR business, that's going to be part of the core business for Meta platforms. And it's going to be a real drag on the company's financials. So given relatively slow growth in a mature business like digital advertising, where there's more and more competitors coming into the market, I think paying 35, 36 times earnings is just a crazy price to be paying right now. Most of the time, I would say that you shouldn't sell stocks based solely on valuation. But in the case of all three of these stocks, the valuation has just gone completely out of whack with the market and what we're seeing from growth in technology spending. And these have been more like hype trades than they have been like fundamental trades. NVIDIA, there's absolutely some fundamental improvement in the business, but we don't know how long that's going to last or what the scale of that's going to be. So buying the stock for 40 times sales, over 100 times earnings, I think is just way, way too much to pay. And investors should be thinking about taking money off the table. Same thing goes for Adobe and Meta platforms. This may be a contrarian take, but this is a time when investors need to be fearful when others are greedy. I think the market is getting way too greedy right now with artificial intelligence. These have been three of the beneficiaries, and that means it's time to sell these stocks. But what do you think? Leave your comments in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.